Good morning, ladies and gents. You can rest assured there's no further audience participation in my section. I'm just going to spend 10 minutes really running through perhaps some of the less obvious aspects of the budget. Okay. Firstly, there was mention in the budget, obviously, we've got Mark Carney coming in July. He's going to take over from Sir Mervyn King as the current Bank of England governor. So he's going to come in, hopefully shake up things at the Bank of England. He's going to have some new powers, so we'll discuss those. But I think the best thing to do is look at the current remit at the Bank of England. We've got two core objectives. The first thing is monetary stability. So they're aiming, perhaps not successfully achieving the 2% target, but the aim is to have a long-term 2% inflation target. The Bank of England wants the international community to be confident in investing in the UK and in sterling. Financial stability, that comes down to protecting against general threats to the banking system, the long-term feasibility of the UK as a trading country. And as we've seen in recent years, the Bank of England acts as lender of last resort, so they've bailed out the UK banking system with quantitative easing, and they're going to have new powers going forwards, but we'll discuss what those might be. Okay. The banking blues, so the situation at the moment with the UK, we've had the base rate of 0.5% now for going on 4 years. Quantitative easing, I think I'll refer to that as QE because it's a bit of a mouthful. But quantitative easing, we've had £375 billion worth of that. Effectively, the Bank of England have been buying up government debt and injecting that back into the banking system. Inflation, the target is actually 2%, as I say, but it's running at 2.8% at the moment, so well above target. And the last time inflation was on target was actually 39 months ago, believe it or not. So, the incoming governor of the Bank of England has got a real uphill struggle here. So what's the new powers? Two key points really. The first one is something, a bit of a mouthful, explicit forward guidance. This is something the Fed have been acting on in the US, and it's effectively trying to build up confidence in the business community with consumers when they're borrowing money, and it's trying to set an expectation of what rates are going to do long term. At the moment, obviously, the MPC committee meets up once a month and they set the rate for the following month. What they're trying to do going forwards is actually say, okay, the situation is that base rate is going to stay low for X amount of months, so that will help businesses when they're borrowing budgets, look at the cash flow projections, and obviously try and build up some more confidence with borrowers. Okay. The second thing, unconventional monetary policy. Now, this is what Mark Carney has been doing in Canada. Canada, in fact, are the only G7 country who've managed to steer their way through the banking crisis without having to bail out their banking sector. Okay. So hopefully he's going to come in and try and replicate some of the actions he's implemented in Canada. Okay. Some of the things we could be looking at are unlimited QE, so that could increase quite considerably in future. Obviously that will have knock-on effects on the economy, which we'll talk about shortly. Negative interest rates, that's been bandied around in the press recently. This doesn't mean that when you place your money in your high street bank account you're going to pay the bank. That means that the big clearing banks, when they place their cash with the Bank of England, instead of getting a positive return, they will actually be paying interest or a penalty for placing that money with the Bank of England. So the idea is effectively that this will hopefully get the bigger banks to start pumping money into the markets, start lending again, as opposed to putting it in a safe haven with the Bank of England. Okay. But I certainly don't envy Mark Carney's job going forwards. So, as I say, I think we can expect quite considerable amounts of QE going forwards. Let's talk about the current funding for lending scheme, where the Bank of England is lending cash to the bigger banks at competitive rates. in the hope that they start lending that cash to the real economy. I think the key point here is it's a clear signal to the markets that interest rates are going to stay low for a very long time. Okay. One of the implications for savers, people with borrowings, obviously, savers are going to be worse off, because they're going to be probably looking at taking risk with the cash now to get a decent competitive return. Probably good news for borrowers, people with mortgages, businesses with debts, they can probably have a bit more comfort that rates are going to stay lower for longer. The problem longer term is going to be what's going to happen to the financial markets. At the moment, there's a great deal of distortion in the capital markets. There's a great deal of cash sloshing around in the banking system, and what's happening is that cash is chasing returns, so that's really going into the stock market and propping up the market at the moment. If there is more bad news potentially out of Europe or North America, unemployment starts to go up again, then potentially we could have another situation where there's a sell-off in the financial markets and all this money perhaps moves back into safer assets. The other problem we've got, when the Bank of England is pumping money into the markets, they're buying up government bonds or government debt, and that's artificially increased the price of those assets. So fundamentally, at some point in the future, the Bank of England is going to want to unwind this QE, and how they do that is going to be really interesting. What I don't think they want to do is to see a huge sell-off of these assets, these government bonds, and to see the bubble burst. Okay, I think what we will see is an orderly sell-off of these assets, because these government bonds traditionally are seen as very safe, secure investments, and the last thing they want to see is these people who, have invested in what they perceive as a low-risk investment. They don't want those people to see a big drop in the value of their portfolios. So for people retiring, it's bad news. When you're buying an annuity, the income generated from the annuity is linked to government bonds. So, the expectation is that rates will probably drop even further in the short term. So that's enough about the banking system. There's mention in the budget about state pension. There's been a lot of talk in the press recently. The key point here is we've got a very complex, horribly complicated state pension system at present. The government basically are simplifying the whole system. They are going to implement a flat rate state pension from April 2016, so that's actually been brought forward 1 year. The key changes, firstly, to be entitled to the full state pension, anyone retiring after April 2016 will need 35 years worth of contributions. That's going up from the current 30-year requirement. Means testing is going to disappear, and so is the state's second pension. Okay. So that's the key points. So who's going to win? Who's going to lose out with these changes? Firstly, I think as Dave mentioned earlier, parents who take time out to look after the children, basically they will get credit towards the state pension. The self-employed historically have only built up a basic state pension, okay, but going forwards they will have an increase from £107 a week to £144 a week state pension from 2016, and hopefully taxpayers will benefit. It should hopefully cost the state less. Okay. And of course there are going to be some losers here. So firstly, we're going to have some high earners who've built up very high state second pensions. They will keep what they've accrued to date, okay? But in future, those people on higher salaries will basically get the same pension as people on lower earnings, the flat rate. And the key point is people with less than 10 years contribution will actually get nothing at all. Okay, so that's a big change. And obviously anybody who retires before the flat rate state pension comes in will actually retire on the current regime, okay, and potentially get a lot less. There's one paragraph hidden away somewhere deep in the budget text, and it just talked about potentially looking at people with a private pension being able to invest in residential property. Now, the government talked about this in 2005 and did a last-minute U-turn. So I wouldn't hold your breath on this, but potentially, the government are looking at this. And the idea is that effectively they're looking at people developing unused commercial premises. So, if you look on your high street, you probably see there are lots of empty premises out there. And the idea is to try and get those converted into residential properties. Okay. But again, as I say, that's at consultation stage, so we'll keep you posted on that. And just as a bit of fun, I thought, let's see, it's 60 years since Howard Worth started trading. Let's see, how money has changed, how the value of money has changed over 60 years. So if we go back 60 years, average salary was £704, and it's gone up to 26.5 today. So in real terms, earnings today are actually a lot higher than they were back 60 years ago. They've actually been a lot higher than inflation, which may surprise you. Average house price, as you can see, considerable increase there, up from over just about 2,000 up to 162,000. So significant increase there. The average deposit account would have grown from £100 to nearly £6,500 over the past 60 years. Gold, surprisingly, I say only, has only grown to 8,136. The reason being it doesn't generate income, so other assets like stocks and shares, they generate dividends. So what you'll see on the next slide is the value of income from an investment. So most of that growth, if you like, is via the reinvestment of dividends on the shareholdings. So UK Equity Investment Trust is just a collective scheme that invests in the UK stock market. Okay, and there's just a summary, everything on one slide to show you. I think one of the key points here is the earnings multiple. 60 years ago, the average house buyer would have only had to borrow 3 times salary. Today it's more like 6 times. So it begs the question, are wages too low or are properties overvalued? So that's quite a scary statistic, really. Okay, but the key point here really is that property, equity investment really are the hedge against inflation. That's where long-term investors need to be to make the money work for them. Okay. And finally, you may be interested to know the average fee Howard Worth charged was £12.47 in 1953. And you may be asking, what is it today? Boom, boom. Okay. So thanks for your time, ladies and gents.